Hi everyone, my name is Beck Rosenzweig. I'm the GM of Investors at LaunchVic. Before we begin today, I'd like to begin by acknowledging the traditional owners of the land on which we meet today, the Wurundjeri people of the Kulin Nation. We pay our respects to all Australians' First People, to their ancestors and elders, and to our shared future. I'm very lucky to be here moderating this session today on mastering the SAFE for success beyond Silicon Valley. I work at LaunchVic, where I manage our investor programs, including our sidecar funds, where we have the Alice Anderson Fund and the Hugh Victor Mackay Fund that co-invest in very early stage startups and often using SAFEs. We've done about 30 investments so far, and we'll go into a little bit detail about what a SAFE is, but SAFE stands for a simple agreement for future equity, and for something that is supposed to be a simple agreement, I don't think I've seen two that have been the same. So let me introduce our panel today, who will be able to share a little bit more detail about this topic. We have next to me here Nick Cust, who's the CPO at Cake Equity, which is a leading cap table and equity management provider for startups in Australia and now in over 50 countries. And previously, Nick was a CPO and held product roles at a range of well-known companies, including Smiling Mind, Redbubble, and Net-a-Porter. Rachel Newman, who is the founding partner of Flying Fox Ventures and moved into a full-time investment role post being managing director at Eventbrite in Australia and New Zealand and working with thousands of early-stage startups as head of startups at AWS. Jonathan Farrer, who's a partner in corporate mergers and acquisitions at Coors Chambers Wentworth, and JF Gauthier, the CEO of startup Genome, a Silicon Valley entrepreneur and world-leading expert in innovation ecosystem development, having advised more than 100 innovation ministries and agencies across 50 countries. So this panel here has had a lot to do with SAFEs across the globe. Maybe to kick us off, Jonathan, I might actually throw to you. Let's just kick it off by talking about what is a SAFE.
What is a SAFE? Simple agreement for future equity, right?
Oh,
that's what.
That's right. Very simple.
No. That's. I think your comment at the start is probably right. I think the idea of a SAFE, and they started, I think, around 2013 with Y Combinator, and the idea behind it really is that, particularly for small investments or bridge rounds, when you're not putting a whole lot of money in, let's not spend a whole lot of money on lawyers trying to negotiate this thing. Let's just have a sort of template document that's really simple, that we can agree to without too much legal negotiation. And so I'm not sure how many of you here have seen a SAFE document, but it's a relatively simple sort of 6 or 8 page document. It's essentially what is a SAFE. It's essentially almost like I describe it as an IOU. It's basically a contract where someone gives you some money as a company, and you say when I do a capital raise down the track, you will participate in that raise, and we'll give you a discount in terms of your entry price into that raise. So there's it's really just a contractual agreement to give you that money and then convert that money to shares as part of a future raise. Really is what it is. Again, maybe we'll get to it later, but it has been sort of, I guess, moved into larger transactions. I worked on a $10 million SAFE for a US venture capital fund last year that already raised $6 million through SAFEs. And I mean, we'll probably talk about it a bit later on at the moment, but that sort of zone is probably not where you want to necessarily be doing SAFE investments. I think they make a lot of sense where it's a small investment that might be 50,000 or 100,000 early stage, keep the costs low. But once you get into those bigger numbers, and we'll talk about it later on, you start getting much more negotiated deals, side letters, and things get a lot more complicated, probably like every other share or convertible note type instrument.
I think what's important also is that it's a equity instrument, so you get out of the debt. And the debt is really, being a debt holder is much more powerful for an investor. So therefore, it was very entrepreneur friendly, but it's an equity instrument, so there's no interest. And it's really a temporary instrument that says, okay, we cannot negotiate the price round yet, but I'll give you a SAFE instead of a convertible debt. So it's simple, no interest, and all of that good stuff.
That is an excellent point because one of the things we do as lawyers is we talk to startups about what are your options, a safe note, a convertible note, ordinary shares, preference shares, and actually when you sort of look at it from a founder versus investor perspective, it is a very founder-friendly or company-friendly instrument because there is no interest. The obligations are pretty loose compared to some of the other obligations in convertible notes and preference shares where there's much more detailed drafting involved from the investor side. So that is one thing to bear in mind. I mean, they were designed by Y Combinator, I think, to be founder-friendly rather than investor-friendly is probably the starting point of where they came from.
And so we have a founder or someone representing a startup on the panel and an investor. So maybe, Rachel, we've heard that they're founder-friendly, but why as an investor, why do you invest through SAFEs and how do you see them in terms of the benefits and risks?
Yeah, so investing in a SAFE, as the two gentlemen mentioned, allows us to just move more quickly. And so if we just want to get the capital in the hands of the founder, get them back to building, then it is a quick and dirty way to say, hey, let's kick this valuation question down the road and we'll deal with it and get a nice sweet discount when it happens. So it honors speed. The other time that it's highly advantageous for investors is in the bridging round. So this usually happens between your seed and your A, and you haven't quite hit those milestones to raise a Series A with the terms that we want. And so it's a way to squeeze a little bit more money into the company, get you to hit those milestones, and we are deferring putting a cost or putting a price on the business. And so that's where we're usually seeing SAFEs is super early or in those bridging rounds. I'll tell you where it's disadvantageous to investors, and that's here in Australia. We have something called ESIC, which is a tax benefit for early stage investors, but that only is eligible on a priced round, so only when actual securities are being exchanged. And so if a company is ESIC eligible and they come to us and they say, hey, we're raising on a SAFE, and we know when it converts, they're likely not going to be eligible for ESIC, then we might encourage them like, hey, let's do this as a price round. So as an investor, if we're pretty sure on the valuation that we can place on this company and we can get that ESIC benefit, then we'll encourage them to do a standard price round. What Jonathan started to touch upon also is that our rights as a shareholder only kick in when that SAFE converts. And so sometimes it is a little uncomfortable as investors. We're in a bit of no man's land. Now, usually you have a great relationship with your founders and information is shared freely, but there's no contractual obligation usually in a SAFE to have some of those rights that we have when we are equity holders. And so that's where things can get a little hairy if these SAFEs don't convert. I think we'll talk about what happens when we stack SAFEs on SAFEs and SAFEs, and then people get really confused on how they convert and lots of discrepancies between different pro forma cap tables. But sometimes we just want to clean things up. We want to convert those SAFEs, and then we want all of the benefits that we have as shareholders. So that's the only time at which investors are like, this isn't feeling comfortable.
And Nick, your software, capital management software is operating, as I said earlier, in over 50 countries. We know that the SAFE was originated in the US and is obviously very popular in the US. It's popular in the Australian market, but can you speak a little bit about the popularity that you're seeing in markets and how downturns in investment affect the popularity of SAFEs being used?
Yeah, it's a good point. So Cake Equity is a SaaS platform. We manage, or basically our goal is motivation through equity. So founders come on board. Generally, we have a fairly robust kind of standardized format of a SAFE note, which is based on the YC Combinator version. Look, historically, we've seen a lot more growth in the US, but Australia is really picking up now. I think we probably process of SAFEs. We've probably overall raises through the platform, and our uses of our documents is probably up to almost $1 billion now. And in Australia, we've probably seen about a big improvement in usage, probably in about the last quarter has gone up about 160%. So there's significant usage patterns of SAFEs in Australia. Typically, so we're probably 80% of that's probably, Australia-based. The rest is the US. We don't see as much in Europe as much as the US. Probably the biggest signs that we see is that the speed that the team has talked about, speed to market of getting the money, is certainly the biggest factor when we see our founders come and want to use the products. But also, I guess we have a pretty sophisticated sort of modeling tool which allows people to sort of predict what will happen over 3 or 4 rounds. And that's often, we talked about stacking safes. Well, that's often one of the biggest challenges, is looking at what will happen on a number of different occasions if I'm running 3 or 4 rounds ahead. So, yeah, Cake tends to play in the sort of seed-based stage, so we don't get into the deeper, sophisticated, hugely complicated mathematics that goes on with deeper rounds. But certainly the modelling around safes is one of the highest usage patterns of the platform as well.
And JF, have you got anything to add in terms of, from a US context, the use of safes and how they've evolved, and if you're seeing as much as this safe on safe stacking as the other panel members are talking about?
Yeah, it's really interesting because, unlike a convertible note where you're going to say everybody is the same and it's kind of expected, and there's clauses that says if one person wants special rights, the majority can bring that back. In the safe, you have a lot more flexibility, but you can make a lot of mistakes. It can make your life very complicated for the investors and the entrepreneurs. But, it was created in 2013 because the power was in the hands of the entrepreneurs at that point, and it grew, right, tremendously. I used the first safe in 2014, right after. But in Silicon Valley, I was an experienced entrepreneur, CEO, CFO, and I started modifying it immediately. Right? In other markets, you're like, okay, it's a Silicon Valley template, maybe I should just adhere to it. But immediately we had a discussion, we had a club round with 3 VCs and about 15 angels. And right away the VC says, well, I need a cap, right? I need this, I need that. And I started modifying it. I was like, yeah, we're going to modify it. But that made it work. And to date, if you go to YC in the site and Safe, you'll see many versions that evolve as the main versions. And, in the last several years, you've seen Safe being, when I talk to experienced CFOs, I've not been a CFO for a long time, and they say, well, always a discount and always a cap. But it's not even available on the website of YC. It's always cap or discount. No, not both. But everybody I talk to, and I talk to a lawyer who does a lot of advises, a corporate lawyer to advise a lot of startups. He's also an angel investor, Harvard Angel Association. He says, yeah, cap, discount, all the time, right? So what's happening in Silicon Valley is the knowledge is dense, people use it, and as a community we start changing it. And as it evolves now, we can see a lot of pro rata rights, with a side letter, because that allows you also to invest when it gets converted, be a major investor, right? There's all of these sophistication that have come out. But as we get now in a place where the entrepreneur doesn't have the upper hand anymore, right? I think we're going to see a lot more resurgence of the convertible debt, which gives power more to the investor.
Interesting, because the research that I've done on safes when it comes to Silicon Valley seem to suggest that there are the different versions available on the Y Combinator website, but I was of the understanding that, the version that's there is the version that companies are generally using, whereas here we see a lot of modification, people making all sorts of modifications, borrowing safe notes from friends that have raised rounds without fully understanding what the changes are. What's the panel's thoughts on, how strict we should be on having a dedicated template that is the safe template that everybody should be using, as opposed to the modifications that seem to take place? Rachel.
Sure. Well, one distinction to add on to the discount cap comment is also if it's a pre-money or post-money. And so in Silicon Valley, it was typically a pre-money safe, or the valuation was on a pre-money basis. And right now, especially because investors have the upper hand, I won't sign a safe unless it's a post-money safe. And that's because a post-money safe, without going through the detailed math, for those who don't know, it basically gives me a much clearer picture of what my holding is likely going to be when it converts. If it's on a pre-money basis, I have no idea what my shareholding is going to be, because it's based on how much money they raise, which is in the future and can't be known. And so that is a distinction that I think, whether or not we are adopting it and made it up. I think that's a much improved change to the SAFE. So I'm all for it being PostMoney. Everyone is just a little bit more on the same page of what things are going to look like in the future.
And as a founder, of course, you don't want that.
Yeah.
You want PreMoney, because the PostMoney means the more money you raise, the more you dilute.
Yeah.
Which usually is not true. You raise 4 million from a VC and they give you 6 million. They increase the PostMoney.
Yeah. And so like that's why investors love it, because we know what our worst case scenario can be. Our shareholdings can only get better from that point. So we love it because it gives us certainty. And so right now, I will say the gravitational center is in a PostMoney SAFE. So that's great for us. Listen, the reason why some modifications have taken place also is because funds no longer have one structure. So sometimes there are syndicates or angel groups or rolling funds or traditional ESV CLPs, and different structures require certain clauses to be in, whether it's long form docs or even in SAFEs. So like sometimes small modifications are necessary. Listen, I will say it would be helpful if there was something a little bit more standard, because I'm very lucky in that my co-founder at Flying Fox is an M&A lawyer for, many years before she came in to investing. She is an eagle eye and can spot things a mile away. And for us, it's free because she's in-house. If I had to pay our lawyer friends...
She did work at Coors, by the way.
She did. She worked at Coors for many years. But if I had to pay my friend here every time we did legals, and given how different they are, that would be a huge cost center for us. And so I would like a little bit more. And you guys have put together a toolkit where you have some standardized docs, right?
We have a platform, Cause Edge, which we give to startup companies at no cost. It's got about 30 legal documents on it, so that's hopefully helpful for startups. I was just going to mention, I guess there's sort of two, and I think Rachel touched on it before, there's kind of two scenarios where SAFEs are used. And the Y Combinator example, which is where they started, is really very small, early stage seed type raises where you're really just putting a bit of money in and having a punt. And I think those examples are probably like there's less, tweaking of documents, because it's just like, again, the origination of the whole thing was we don't want to spend time and money on lawyers for a $50,000 investment. So I think that there's probably less tweaking. We do have, I guess as you get more sophisticated, like if we have US venture capital clients, they will have certain information they need, and so you get side letters and etc. But they're tending to come in later. So I would sort of distinguish SAFEs, which are the early stage, I'm just going to have a bet and hope it all works out, versus I guess they're being used more as well because it's a relatively tough market at the moment. People are trying to avoid down rounds, and so the way you do that is you either use a safe note or a convertible note. So that's part of the reason I think probably there's been a bit of an increase in SAFEs in Australia. And those SAFEs might be raising, the sort of millions of dollars I was talking about. And so you are getting lawyers looking at documents and side letters and all the drafting we've talked about. So it's probably worth, I guess, distinguishing those two scenarios, because I think that the amendments will be different depending on how much money is on the table.
Yeah, I was just going to say the ambiguity around that is probably the most stressful thing for founders that we see, which is this is a dance between founders and investors, and being founder friendly as well as being investor friendly is really the balance that's trying to happen there for the SAFE note. I think typically our SAFE it has a cap, generally has a discount. One of those is favoured based on how many shares it converts to. That's typically what we're seeing as a bit of a standard, but there is a real mix around that we see. And I think the important thing as a founder, if I take the founder side, is to understand that and know what's going to be happening when that converts, what the terms mean. There's enough documentation out there for everyone to read about. It's also free to get started on Cake if you want to use Cake. So I think they're the things that really we should be talking about, standardization and what's fair for both sides of that party. So I think that's the crucial thing. It's got to come back to basics, which is the goal was to get funding quicker and easier, and both parties aligning. And I think cutting that period of time down, particularly for founders, you don't want to take them out 6 months of their life having to raise money. So I think that's really coming back to basics and at the early stage of what we should be focusing on.
It's been interesting to see how, as the market exploded, the startups exploded, the VC investment exploded, accelerated in the last 10 years, you saw the SAFE becoming popular and becoming used for everything. Right? And 2 years ago, one of my friends in life sciences at Breakthrough Technology went to see some VCs. Within 2 months, he had $10 million. And Lightspeed, a tier 1 VC, it's 2021. Great, they gave him a SAFE for $10 million. So then they're expected to raise a Series A really quickly, but then they start hitting their milestones and they start raising in January 2023, and they can't raise. So now they have like 4 months of cash, and the investor has no conditions to force some changes, to take more power, get more stock. Very difficult for the investor. So when the market start going sideways, it's not as good. When you expect the rhythm of every year you're going to raise money, it's going to convert, right? It's a temporary instrument that goes well. But otherwise, it's very scary for the investors, right? Because you have no power to force conversion, which you had with the convertible debt, and so this is very scary. And now, it's like the SAFE will be used only in those cases where it's early stage, and you want to put money temporarily. The terms are not very very well defined, and it's good for the angels because they say, well, if it takes longer, I have a discount, I have a cap, and I'll be part of the close round that is even later. I'm okay with that because then I'll have the conditions of the Series A investor. This is really good. If I have prorator rights, I have major investor conditions. That's really good. But now I think the clock is turning in the other way.
The one thing I just wanted to add on what Nick said is for founders to understand what are the terms that she or he is signing on to and what are the implications. It's standard practice when we make an investment on a SAFE that we do a pro forma cap table, which is this is what the cap table will look like when it converts, and that all parties agree to it. So when it's time for it to convert, there are no questions, and there's no one fund thinking it looks another way and the founders thinking it looks somewhere else. So we build out that model, or we can do it on cake, it sounds like. And then we all agree to it. And I think that would be a helpful standard practice, even if the SAFE is not standard, but if by practice it is, we are all party to this round or to this SAFE, we are going to agree that this is what it looks like when it converts. And then, of course, when you're adding another SAFE on, then you say, this is what it's going to look like, because those stacking SAFEs have dilutionary effects. So I think it's just really important that everyone is aligned. The documentation sometimes could be open to interpretation, but numbers in Excel are not. And so you take what you can see in the paper, you put it into an Excel doc, and you say, I agree that this is how many shares we will each have when this cookie crumbles.
Which is also to your earlier point around pre-money and post-money, why things need to be very clearly defined up front. Rachel's point was around that caps should be post-money stipulated, but I think the most important thing is that they actually say whether they are pre-money or post-money so that everybody is on the same page about what's being talked about. So we've talked about a few examples of when it's really useful for SAFEs to be used. Can we flip that on its head and have a little chat around, examples of when a SAFE should definitely not be used? Perhaps Jonathan.
Probably, I think everyone's probably touched on it, the SAFE stacking issue. So that is something. I mean, if we're advising an investor coming in on a SAFE, and it's not the small one I talked about before, it's a significant investment, we will typically suggest they actually put a cap on how much more they can raise through other SAFEs, and a most favoured nations clause as well, so that they can't sort of raise money on better terms than what we've got. So I guess that's how we try to ring fence that particular issue. But again, not it sort of amazes me actually how few lawyers. People think it's a SAFE, I don't need a lawyer. If it is one of these negotiated ones, you do need a lawyer, because the example I mentioned before where we came in and advised a US investor on a pretty significant investment, that already raised several $1 million under a SAFE which their lawyers had drafted, and it had a whole bunch of issues with it, including a liability cap. So essentially liability is limited to the amount of money you put in. So I sort of explained that to the lawyers on the other side and said, so if someone's put in $1 million and you default on conversion, the most they can get back is their $1 million, even though the company might be worth, 5 times more. Oh, that's probably fair, and that's why it's not in the precedent. So again, I'd go back to the point I made before. I think with simple SAFEs, small amounts of money, that's fine. But once you get lawyers and drafting involved, it does become a lot more complicated.
And you sometimes don't necessarily know what other parties to the SAFE are ascribing through side letters. And so I'm very lucky, again, because my partner is a legal shark, but she will very quickly find out who has a most favored nation clause, and we will put a side letter in to have that as well. But in all transparency, it means that there might be a bunch of other parties who are signing the same doc who are unaware that these side letters exist. So again, when it's becoming more sophisticated and you have more sophisticated firms participating, it is not as straightforward as, oh, we're all signing the same documents. One of the things that we do right away is if we are signing a SAFE, we say, can we see the copies of every SAFE that everyone else has signed? And we have someone on our team who, like with a fine-tooth comb, make sure that every word is word for word. And then we ask the question around most favored nation, or we have friends in high places who tell us we have a most favored nation clause, and we can be party to that in a side letter as well. And it's not that we're sneaky, but every party kind of has a responsibility to look after their own contract. But it would be a mistake to think that you are all signing the same thing unless you ask.
So, of course, for the entrepreneurs, it's entrepreneur friendly, so you want to use a SAFE as much as you can, right? This is great. So it's good to say, and you want to, a pre-money valuation, and you want all of this stuff. But at this point, right, get the money. And if the investor asks you, let's go a convertible note way, you'll say, yeah, let's do this, because it's hard to raise money now, right? So it's very important to be mindful of the times.
So JF, are there any particular things that, from a founder perspective, founders should be looking out for on, in the SAFEs? Rachel's spoken a bit about from an investor perspective and the most favoured nation clause. But
yeah, I wanted to ask: does everybody know what the most favored nation clause mean? Anybody doesn't know? Yeah, okay, so that means that as an investor, if you have a most favored nation clause, the best terms, you'll get the best terms in the end. So if they give better terms to somebody else, it's going to come back to you also, right? So this is very important. And so you were asking...
I was just saying, is there anything that founders in the room should be looking out for in SAFE documentation?
Yeah, I mean, at least, of course, you want to, get a great cap and have a low discount and not have too many letters, right? Side letters of pro rata, because when you get to the next round, when you get to the VC, they want to clean it up. And now they're fighting with your angel investors. They're trying to squeeze them. And the more complicated it is for them, the more complicated it's going to be for you, because then you're going to be at the table negotiated with your angels that they give up their rights to make space for the Series A. And that's not a great place to be at. So you want to keep it simple. You want to be smart about this and, negotiate fairly and tightly with your investors, so that you don't have complication of a lot of different terms, right? To explain to your VCs and really straighten at the end.
There's one clause I just want founders to watch out for in convertible notes, and that's whether it's redemptive or non-redemption. And that basically means, so convertible note is like a loan. We're going to give you money. Ideally, then it converts into equity when that's what the convertible note part. And then usually it has an interest, so 5-6%, whatever it is, accrues, and then ideally that's capitalized. That just becomes more equity. No VC worth her or his salt actually wants 6% back. Like we just want more equity. But the redemption clause is really important. Redemption means that when it's time to mature, the investor can say, that 500K, I want it back in cash. Don't convert it to equity, I want it back. And that's problematic because I, as a VC, and hopefully the other good investors, in that round, and you as a founder want that capital in your business. You need that for your operating costs. And so we always make sure, if we're going to be party to convertible note, which, by the way, again, while the macro headwinds are in place and it's more favorable for investors, we're seeing more and more convertible notes. We're seeing much more structured deals, which I'm sure you're seeing, Jonathan, which just means like funny business. But we always make sure that there is not a redemption clause in the con note, because we want to keep all that money in the business.
Yeah. And as a founder, also, you want to make sure to always say no to a redemption clause. Just say no right away. So absolutely not.
Unless it's at your election. That's okay.
We see a bit of maturity dates slipping into safe notes. So that's probably something to watch out for, is there might be a trigger based on certain maturity dates. So it might be if you don't run a raise by this point, something will happen. So definitely things to watch out for to get educated on is certainly pre and post money. That's no doubt, because a lot of contracts we still see, and obviously the cake one is post money, but we still see a lot of ambiguity there where it's not mentioned. So certainly just getting educated on that. Maturity dates definitely slipping in, and just triggers there that they're generally there for a reason, so that there's something, something doesn't drag on for years. But it's just important to know all of those terms and what they mean for you as a founder. Even though taking $1 million now when you've got nothing and you're desperate might be helpful, I think coming down the track and the impact on early angel investors, friends and family who came in early as well, you want to be clear about what's going to happen. So get a modelling tool, start playing around with what could happen in certain scenarios. I think is definitely the way to go.
Let's mention one other thing. I think we've touched on a lot of the issues, but one other thing that people don't think about is preemptive rights, and when you actually convert. Is the conversion exempt from the preemptive rights regime in the shareholders' agreement? So for those of you who don't know preemptive rights, essentially when you raise new money, your existing shareholders have the first right to participate in that capital raise. So if you have a whole lot of safes on issue and you're contractually obliged to issue shares to those people, but your shareholders' agreement doesn't sort of carve that out from the preemptive rights regime, you may have an issue in that you've got to go through that preemptive rights regime, but you're a little bit screwed if everyone takes up their rights and you can't issue the shares. So there's a whole bunch of ways you can counter that, but people often don't think about that when they're raising the money.
Changing the theme a little bit, because we do have a number of policymakers in the audience at this conference. Rachel mentioned earlier around ESIC, one thing to be aware of from a policy perspective that could potentially change for founders raising, or for investors investing through safes that they're not currently included in ESIC. I'm curious from the panel if there's anything else from a policy perspective, perhaps JF from your experience overseas, that policymakers should be aware of regarding safes.
Well, I think, for the policymaker, it's not about knowing all of these, right? But it's really about getting the knowledge into your ecosystem, making sure it's available. And especially if you're, a non-English country, that there's, rich explanation in the language of your country, so that all your founders can understand these terms, what they mean, what are the problems and the risk with each of them. And in Silicon Valley, the private market does that, right? If you want to have a price round before Series A, there's a seriesseed.com, and you just go there, and some lawyers and people have agreed to the terms, and it's entrepreneur friendly, but the VCs have all agreed to it. But in other countries where the private market's not as sophisticated, right? I always propose that the governments actually create websites where you can have the latest, the standardized document. When we were in Taiwan, they had all of these structures where they, to raise money in China, they needed to be incorporated in Hong Kong or in Tokyo. But it cost them like $50,000 to do this with lawyers, as opposed to having one website where you say, okay, this is how you do it. These are the documents. You don't need to, 1,000 startups go through the hoops and pay $50K in legal fees. So I think the role of the agencies, the local agencies, is to create those sites with standardized documents and evolve them, like YC did, like seriesseed.com. You can see it several generations later. But that role, if the private market doesn't take it, I think someone has to take it. The innovation agency, the ministry, or maybe the fund of fund, the organization that do direct investment on the government side, so that it helps and facilitates, removes the friction of negotiating with lawyers, and it educates the investors and the entrepreneurs when you have that. And they might negotiate a few things outside of that, but that would help so much if you take that role on.
And so we've heard from Jonathan at Cause that there's some resources available there. There's resources available through Cake Equity. I know that there's some resources available on the Australian Investment Council website. I think the question is, are all of those resources aligned, and are they being updated at a regular basis? Sorry, Rachel, did you have
There's one thing I just want to add on the policy front. If I am to be critical of our policy just for a moment, I feel like it sometimes is trying to do too many things at once with one policy. So we have ESIC, which gives you a tax benefit. It should the company either be a boom or a bust for the investor, but there's a threshold. And so it's super early. So like anything under 200K in revenue in that calendar year, anything more than that, you're no longer ESIC eligible. And so then it forces you as an investor to say, I can get a tax benefit doing something super, super risky, but as soon as it's actually starting to show some promise, I no longer get a tax benefit. Then on the fund side, we have something called an ESVCLP, which is the typical structure for an Australian VC fund that has a bunch of tax benefits, both for the LPs as well as for the manager. But there are all these restrictions around the percentage of capital that has to be deployed in Australian companies. So the question is, with that policy, are you trying to build up the investment ecosystem, or are you trying to build up the Australian startup ecosystem? And trying to do both with one policy, I think, actually puts a cap or a limitation in what is possible. I'd much rather see benefits for investing in Australian companies, and then foreign investors can enjoy that as well, or benefits for deploying capital for Australian investors. Let them invest in overseas companies. And then what you're doing is helping to generate wealth. And so I just don't like these policies that are trying to double hat. It ends up being a bit restrictive. And I feel like some of our policies here are trying to do a little too much. And they are capping the potential for both our investors to make as much money and recycle that money back in the ecosystem, and for our founders to attract as much capital as possible and be able to pass those benefits on to a whole range of investors.
Yeah, I'd add to that so our documents are reviewed regularly, so we update them regularly. We're working with legal partners around Australia and around the world. I'd argue the same point, but probably in the being pro startup focus. So our policies should really enable startups to get funded and move really fast. And they should have low thresholds there in terms of bureaucracy and what they need to do to hit those points. So I think as much as possible, like standardization of the documents, pushing, working with accelerators, working with platforms that have all of these enabled, it would be certainly a great step forward for a lot of the pieces, at the government level, and working at a founder-friendly point of view as well. So making sure that, while the investor side is practical, the founder side of things is also equally as motivating.
Excellent. Well, we have a few minutes left for some questions. So if anybody does have a burning question about safes, please put your hand up. We don't have a roving mic, so I will lend you mine.
Hi, my name's Jack. Rebecca, a question for Rachel. Sorry, oh my God. I had that in my mind the whole time, sorry. You said pre and post money safes. Could you give like an example so that we could think about with numbers? Yeah.
So if the safe was 10 million pre-money, that means when they raise $2 million, all of a sudden the valuation is 12. So let's say I put in an amount of money that was worth 10%, right? So if it was a post money, it meant that it was 8 million, and then they raised 2, and then the cap is 12. Hold on. Let me try to explain. It basically, it will be the delta between it being pre. I'm trying to figure out the easiest way to tell you this without having to walk you through the lines of an Excel. All right. Are you?
I can try it. So the pre-money defines how much your share is worth, right? So if you have 10 million valuation, you have 1 million shares, that's $10, right? And the more you raise money, your share price is fixed, right? So then for the more you raise, the more you're diluting the investor. The opposite is when you put the post money, the more the money is raised, your pre-money valuation goes down, right? You have a 12 million post, you raise 2 million, your pre-money is 10. You raise 3 million, your pre-money is 9. So now your share price is going, so it's diluting you. And that's basically what the complication is.
I often have people think about like a pizza pie and your slice, and in a post money, you kind of know how big the pie is, and then the only question is how big your slice is. In a pre-money, you know the size of your slice, and the size of the pie is going to change. So if you think about it as pie or pizza, That will help.
Rachel wants a large pizza.
Yeah, I want a small pizza and a big slice.
But basically, the pre-money make sure that your share price for the founders and the previous investors is fixed. And the more you raise money, the more the new investor is getting diluted. And the post-money is the opposite. It's like the final price is set, and the investors and the founders get more and more diluted the more you raise. So usually we always raise based on pre-money, right? This is how we raise. And that's a concept that is pro-investors to fix the post-money.
It's very technical. The other way to think about it would be pre-investment versus post-investment. And the valuation's determined post-investment, then you work out the share price based on that. So changing the language also makes it easier to understand, because this comes out of a lot of legalese confusion that the world's always been driven around. And I think the other way to think about it is flipping just the language around on that as well. It'll be easier to understand. Go on to Cake, you can switch between pre and post money, and you can have a look at it.
Perfect.
Okay. Hello, I'm Jalal from Oman Investment Authority. First of all, thank you very much for the insightful session that we have here today. I just have two questions. The first question regarding the pre-money and post-money of SAFE. Like in our emerging countries, like specifically the GCC countries, because of the amount of the VC funds, pre-money SAFE is more favorable to the startups because it's more, for them, they feel it is more safe and so on and so forth. However, it doesn't protect the investors, as you mentioned. Now, how do startups here in this ecosystem receive post-money valuation? Like, do they accept it, that their shares will be diluted, your shares will not be diluted? The second question, you said that, Rachel mentioned that you help them of understanding it through the Pro Forma cap table. Now, with so many subsequent funding rounds, probably the cap table might not work or might have some issues where it might not be true. Did you have a case where the pro forma cap table was not true because of the subsequent rounds and the valuation was higher than you told them, and then you had a fight with the startup? Or you still did not have that case? Thank you very much.
I'll answer your last question first, which is just every subsequent round, we just update the pro forma cap table. So even if we're not participating, we have to be notified if they are taking more money on a SAFE. And so if they do that, we say, okay, let's model this out. And we warn them like, hey, we're getting dangerous with the number of SAFEs. Let's clean this puppy up. Let's convert. And to Nick's point, we normally have a maturity date in our SAFE notes. Sometimes we have one company where we've hit the maturity date and we have chosen together, we've elected as investors and founders not to convert. So we have extended the maturity date because it would not benefit them right now to put a valuation on their business. And so first of all, I want to debunk this myth that it's always this adversarial relationship between founders and investors. Usually we both want the same thing, and you never want to set terms early on that's going to cut your nose off to spite your face. So you need to keep it as vanilla as possible because you need to attract downstream investors. So the most important thing is that you're actually aligned and that you're clear on what everything means. So we've never had a fight with a founder. Sometimes we've just had some back and forths with co-investors to say, this is what my cap table looks like, this is what my pro forma, and we just kind of clear up how we're interpreting sometimes some loose legal language. But that's why every time money comes into the business, you say, okay, what does this cap table look like? So you're constantly updating, it's not static. And what was the first question about our founders accepting? Yeah, right now founders are accepting those terms. It is what it is. It's a good time to be an investor.
I would say the whole pre and post money comes down to whether you have a valuation cap in your SAFE notes. So, one of the points I was going to make is SAFEs are really simple except for the couple of blanks that you need to fill in around discounted valuation cap. But anyway, there we go.
Yeah, so we are pretty much out of time. I think you can all agree that something that is supposed to be very simple has a few nuances and may not be so simple, but hopefully the panel today have debunked some of those complexities for us today. So I'd very much like to thank Nick, Rachel, Jonathan and JF for joining us and discussing SAFEs.
Thank you, everyone.